activists. Bill Ackman's takeover bid for Allergan may be a game changer for the industry. We'll see why activists have gotten more ambiguous and are going after far bigger game.
And we'll see what companies are doing to fight back. eBay may have the textbook campaign, perhaps, when Carl Icahn came calling. A full hour on the new era of activism right here on Market Makers.
Welcome back to Market Makers. I'm Stephanie Rule.
And I'm Eric Schatzker. Last hour, as you know, we talked to Bill Ackman of Pershing Square about his latest investment. If not an unprecedented move for an activist, it's something we haven't seen the likes of for a generation. Bill Ackman teaming up with Valiant Pharmaceuticals to buy rival drug maker Allergan. This makes it a great day, wouldn't you say, to focus on activist investing? We're going to spend the rest of the show doing just that with two special guests. Bill George is a professor of management at the Harvard Business School. He serves on the board of Goldman Sachs, ExxonMobil, and the Mayo Clinic. And John Stanzinski is here as well. He runs Blackstone's advisory business. You might think of it as the firm's investment bank, somebody who has worked with a number of activists and knows a great deal about the business. So, gentlemen, let's begin with this. And perhaps, if you don't mind, John, I'll put the question to Bill.
Okay.
When I look at Bill Ackman teaming up with Valiant Pharmaceuticals to buy Allergan, I think, and a lot of other people think, I've never seen this before. This is a game changer. Corporate boards around America should be running for the hills. Should they?
Well, they certainly ought to prepare. I mean, the key is how well prepared are corporate boards. It's new for this era, but certainly not new for the 80s. The Raiders in the 80s teamed up a lot, and with the junk bond, with Mike Milken and all, and in the 90s we saw a lot of private equity firms doing similar kinds of things. But I think Bill Ackman's a very tenacious guy, very aggressive, willing to make big bets, willing to take big losses to get big gains. So you got to admire the guy.
Would you liken this to a corporate raid?
Well, of course, yes. I mean, yeah. I mean, you know, I think it's
so. Bill Ackman
Pearson,
is no longer.
I think we shouldn't just look at Ackman, though. He's investing with Pearson. It's Mike Pearson that's making the big bet here, and he's saying he's going to bet on a whole different P&L structure, taking down R&D, marketing, and sales.
No, but that's not corporate raiding. That's just M&A. Wouldn't you say, John?
I think I would prefer to describe this, Eric, as fact-based activism.
Hold on, one more time.
Fact-based activism. The best activists spend 3 to 6 months really embracing what they're going to invest in. In this case, you have a situation where Bill is investing in a vision, and rather than basically doing the in-house work, which he's done many times, and the best activists we know do 3, 4, 5, 6 months of work, here he's partnering up with a very skilled CEO with a track record.
What do you think the risk is that this is one and done? It's legal right now, but could regulators look at this and say, you know what, this is too slick, this is too cute, not again?
Well, I think, no, I don't think they can, there's nothing illegal about this. I think you could question the 10-day time period if you're going to go beyond 5%. Right. But no, but I think you've overlooked Pearson here. Pearson, as John was saying, has a very successful track record of acquiring companies and restructuring them. And that's really what's happening here. And the question is, at a certain point in time, he's got to operate all these companies he's put together and build them for the long term. And that's where the jury's still out. But he's done a brilliant job. And so I can easily see why the two of them have come together. That's not hard for me to understand at all, because they're of like mind. You just heard it.
I think for a moment, good to rewind, if you will, for a second and just listen to Bill Ackman in his own words about the merits and rationale behind this deal.
We don't want to partner with everyone, right? We want people we want to partner with the best management teams in the industry, in industries we like, and companies that have competitive advantages. I mean, this is not about making a pop on a stock. This is about establishing a large position ultimately in the combined company. And that is an extremely attractive proposition, not just for us, but for Allergan shareholders, for Valiant shareholders. I mean, I think that's a very good model.
So if that's the case, we might not see, John, Bill Ackman in Pershing Square repeat this exact structure, this exact approach, maybe even never again. But Bill himself told us that he does see this as a model for hedge fund activism. Would you agree? And will others look at what he's doing and say, hey, wait a second, I can do that too?
Eric, I think there's probably about 75 or 100 different types of activists. No two activists have the same type of model they follow. I mean, for example, Value Act is in the shareholding, as you know, of Valeant
Pharmaceuticals.
And Jeff Ubben has a very different approach. He's been a long-term investor and has had a profile on the board. And so is it one sort of case study fits all? No. But this is now a scenario that a lot more chief executives are certainly, to your earlier comment, going to think about when they think about this is big money activism. And let's remember, Bill is unique the way Carl and a few other people are unique in that he is prepared, as my colleague said over here, to invest a lot of money up front because he believes in Mike Pearson's track record and his vision for this combined entity. And most importantly, he wants to be an ongoing shareholder in the combined entity.
Then if you're advising Allergan right now, or I turn to you, if you're sitting on Allergan's board, what's your next move? What are you thinking here?
Well, the first thing you should have been prepared before.
Right.
And yeah. I think you have here two very different philosophies. Allergan has a big investment philosophy. They want to build a giant company for the long term. And much like Big Pharma, there is a split going on in the pharma industry. Some people say, let's go more to the marketing of drugs and we'll purchase drugs from biotech companies and go that route. Others are investing for the long term. But I think the key is you got to have a plan to stick to it. And PO is doing that, so I can't be critical of him for that. But you really have to have your board fully prepared as a board like PepsiCo.
Can you think philosophy when you wake up yesterday and Bill Ackman's standing on your front door saying, hey, guess how much I own of you?
No, but I think there's going to be a war here. I don't think he's going to capitulate easily. I really don't. I think you're going to find him shedding assets, doing everything he can to stay independent. I don't think this is going to be a friendly deal in the end.
Is this a shot across the bow of every corporate board, in as much as, to Bill's point, you need to be prepared? Look, for example, what Novartis is doing with GlaxoSmithKline and Lilly. That, to some, appears to be the anticipation of activism.
Eric, it's very simple. If you go into every boardroom in America right now and you say to the board, what is your biggest fear? The biggest fear for those who don't have activists, they do not want an activist. The worst scenario is those that are obsessed with the activism, and most importantly, here's the punchline, the CEO doesn't actually wake up, look in the mirror and say, why don't I look at myself and why don't I become the activist with respect to my own company? In other words, wake up and become an activist, Mr. or Mrs. CEO. And I think if the best CEOs actually do that, they think about themselves not from the standpoint of being a caretaker, but as a visionary. Bill Ackman's interested in Mike Pearson because he sees him as a visionary. We can debate that in terms of R&D, we can debate that in terms of cost structure, but that is Bill's view of him being someone. So if you're a chief executive, and those that I'm very close to, I say, look, pretend you're an activist. See yourself as an activist. Don't sit there and worry and be obsessed about an activist coming in the back door. No, be pragmatic. Look at yourself. The way activists look at companies, that's a fairly easy playbook. There are about 10 criteria, and if a company is insightful, they'll look at them. Rather than this quarterly earnings nonsense and playing to the analyst community, focus on, okay, here's how these 10 activists or these 20 activists would look at me. Am I really returning to my shareholders what I should be returning?
Yeah, and that's exactly what I would recommend to boards of directors and have to several of them, that you have to think of your business, take a group of smart MBAs or people or analysts and go say, how would you take this company apart if you're an activist, and then act. That's exactly what Joe Jimenez did at Novartis.
But what both you guys are saying, in effect, is that that's not what's happening in corporate America, that for however long, 10 years, 20 years, 30, 40, 50 years, CEOs have not looked at themselves as custodians of shareholder value. They have not thought of themselves as activists.
They're organizing corporate boondoggles, Eric.
Eric, this is a shocking question. It's a shocking question. I think it's fair to say with the advent of shareholder activism creating a very credible asset class over the last 10 to 12, 15 years, you now have a decoupling on the board of the power among the chairman, the chief executive, the emergence of the non-executive director, which I think is actually quite good for the chief executive because it gives him or her someone to talk to, And it's actually given boards more power and authority, which 10 years ago was not the case in corporate America.
Well, I actually think the leading companies have done precisely this. I think that's what they're doing. Like who?
Yeah.
We mentioned Novartis. I saw Whole Foods do it. I think Apple was fully prepared. The best example I can give you is PepsiCo. They're fully prepared. They have two businesses. Nelson Peltz comes in and says, break up the company, break into beverages and foods. Indra saw this strategy back in 2004, and she started reshuffling the company, got rid of the restaurants, and got them into two businesses they want to be in. They can demonstrate $1 billion of savings every year to the bottom line for the combined businesses. You can go see it at a company like Walmart, where they get the leverage, and she's on the right side of the trends. Coca-Cola's not. That's why their stock's way up the last 2.5 years.
Right, with a woman CEO.
And why not?
Hey, she's one of the best. Women or men, she's one of the best. Let's not put gender in. She's one of the best CEOs in the world, I can tell you.
Glad you're here. All right, we have to take a quick break.
Yep.
We do. Coming up, we're going to talk about more deals because they're not all slam dunks. We're going to look at the winners and losers of activist investing. This is Market Makers, a truly special day, taking a deep dive with some of the smartest people in the business. You're watching Bloomberg Television, streaming on your phone, tablet, Bloomberg.com. And now we're on Apple TV and Amazon's Fire. Stay with us.